Gary Wagner of the goldforecast.com joins us today to take a look at a few gold charts and what they're saying. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Gary Wagner, welcome back to Metal Money. How are you doing?
I'm doing very, very well. Thanks for having me.
Glad to have you back. Always got to take a look at what Aloha shirt you're wearing, making me jealous out here in Singapore. You know, Gary, looking at a monthly chart for gold, we clearly see the double top of 2011 and 2020. This will be chart 1. And shortly after the top of 2011, gold received heavy pressure at about 1800 and plummeted to about 1200 back in 2012, and then went sideways to about 2018. Today, gold is hitting that same seemingly heavy resistance level of some 1800 to 1850 as it did back in 2012. How important is it for gold to maintain that 1800, 1850 level in the short term with consideration to what we saw back in 2012?
That's an excellent question, but I'm going to answer it from a different vantage point. We're talking about the two record highs, all-time highs in gold. The first occurred beginning, about 2008, moving up to about the middle of 2011, 1920, approximately in that area. From there, it oscillated for a long period of time. It might have been a year to 2 years, if I'm not mistaken, between 1800 and 1500. And then it broke hard. And see, I look at it, not that $1,200 point, because the end of 2015, beginning of 2016, it traded to $1,020. You remember that, right? And so we had this long multi-year correction. And then from there, we went back into a cycle. Now, in this latest cycle, it did make it made a higher high than the previous high. But once again, we went into it, in this case, not even a multi-year, a multi-month correction, because it traded from a top of 2088, hit a bottom of approximately 16. I confuse it sometimes, but 1680, had a rounded top, and then hit that second bottom. March 1st was the first one of this year, March 31st. See, to me, that is the signal. That is the moment in time, the first of the double bottom, in which we went from a bearish market to a bullish market. That's where the flip was. And in 2015, we got a flip also, where it started to move back up. So in terms of the actual number 1800, we've hit 1660. That's the most important thing. That's our bottom. The fact that it went through 1850 today is absolutely significant. 1800 was taken out, but 1850, I get a double harmonics in terms of my technical indicators, because you've got two different indicators coming up with that same number. And that is the 200-day moving average. We broke through that. Really, really important. Secondly, it is the 23.6% Fibonacci retracement. So when you have two completely different types of technical studies, all pointing to something, it gives it strength. I also read that there was some data that came out of the CFTC last week that said that big institutional players were going to step into the arena, so to speak, if the market broke 1850. We saw that kind of all coalesce and that perfect storm kind of move. And that's what moved the market up $20 on Friday, $30 today. We look at minor resistance at about 1880, and then major resistance starts at 19 and goes up to 1946. So to answer your question, how important is 1800? It's critically important if we're going to take another move back to a new all-time high, a higher high than 2088. 1800 was a critical number in 2011 because that was the top of the market. It hit 1910 and it bounced off of 1800 at least a dozen times before it broke. I believe the number was 1553 was the spot that it broke. And then we went into this long winter of gold and silver selling lower. But 1800 is significant. It's a psychological level. I believe it's the 50% retracement of the fib levels that we're using on our charts. So that was a significant number. And now that we're past that, 1850 is a number to watch in terms of needed for critical support.
All right. So I guess we get to flip that arrow around going down. Now we can change it to going up. It's great news, Gary. On the retail side, guys have been snatching up silver, physical silver, consistently, constantly. Although looking at the daily silver charts from just a few days ago, we see silver basically going sideways. Why did the sideways movement for silver happen despite the ongoing consistent high demand from retail investors? And note this was just before the run up to $28.
Sure. Approximately 3 weeks ago, I did a show called Mugs and Metals, and it features analysts that have a beer mug, and they're all like, I'm always casually dressed. I'm not elegant like you. I can be, but I don't look as good. But and they talk casually about the silver and gold market, and silver was the main topic because the gentleman that hosts it operates a very, very large retail silver business in the United States. And he told me about a vacation in Florida where he went to work. And of course, if he sells a coin, he's got to hedge it until he orders it. And he said that he was like, he couldn't even meet the demand for physical silver sales. They were that strong. And at the same time, paper is a whole different issue. So when I look at silver, I kind of look at the paper side of it, and there's a little less tangibility. In other words, today it went to $28. See if you can buy a coin for $30 or $40 now. I'm talking about a standard US or any country silver, a 1 ounce round. The premiums have skyrocketed. Is that correct?
Absolutely correct. The premiums have absolutely gone up.
So even though it appears flat on a market, the reality is it is not correctly telling you what it's going to cost you to own physical silver. Now, you can own paper silver, but there's a difference. I trade futures. It's what I was trained in. I've done it for 35 years. I do it because of the leverage, which means you can lose a lot of money quickly or make a lot of money quickly, but both are true. It's not a one-way street. There's something very, very warm and fuzzy, let's say, about having a couple of coins in your safe in your house. And so there's that high demand, and that demand won't go away, especially given the current environment of not only the US dollar, but of currencies worldwide. I think there's a race to zero to devalue their currencies. And listen, fiat currency is something that every silver bull and gold bull have an underlying feeling as they relate to why they want to own that precious metal. Why? It's got value. You can hold it. It's been used for thousands of years. And I think that the value is just as true today as it was then. And so what we're seeing in silver with that kind of sideways movement is the price per ounce might not be, although it is now, not be moving that much, but the premiums were. If you look at gold, gold was very similar in that it would have this move up and then trade sideways. And I call that a stair step move. In other words, you get a price ascent, it consolidates at a higher price. And in a candlestick chart, the beauty is it's defined by alternating candle color. You stop getting lots of greens in a row or lots of red ones in a row. Body sizes start to get small. But in a bull market that is not parabolic, and I'd much rather be in a slower trending market than, because parabolic up is paying down. But so what we're seeing is gold move up, it then trades sideways, goes up, sideways, goes up, and then as it breaks through various key levels, and really the 50 day moving average you broke through a little while ago. The 21-day exponential crossed above the 50, which is your first sign. Realize that the 200-day moving average that it broke through today, gold's been trading under for quite some time. And you can paint any picture you want, but the truth is, when a commodity or a stock is under the 200-day moving average, the long-term prognosis, or better put, the market has been in a long-term bearish or bullish market. You can't argue with that math. You can believe it's going up, you can believe it's going down, and it wasn't until today, was it? Yeah, today that it broke solidly through that, and that's where 1800 comes back. So I'll bring it back to the story, and that occurred, I believe, was 1798, 99, and kept coming down, and then you had 1800. Those two numbers coalesced, and so that's why 1800 is so important in gold, because it was a true breakout above a strong resistance point. We broke through another one today. And that's for people that want to see the metals move up. And I have a feeling it's not only you and myself, but probably most of our viewers, right? It's good news.
Yeah, absolutely good news. And interesting, you touched on how you're looking at the candlesticks and looking at the candlesticks as they get smaller. And speaking of those small candlesticks, I want to talk about doji candlesticks. Before the silver run up to $28, excuse me, we saw doji candlesticks on the tail end of the weekly silver chart. So for our viewers out there, is the doji a sign of a trend reversal or more of a market indecision of where the price is going at the moment?
The way I look at it is, if a market is going up and the bulls are fully in control, when you get that doji, I look at it as during a relay race when they pass off the baton, except it's the bullish faction getting it grabbed by the bearish faction. So it can be an indicator. However, for it to be a valid signal, you really need to have it form what's called a variation of a three-river evening cross, a tri-star top, a southern cross, a northern cross. In other words, it is likely that it's telling you you're at a short or a long-term top, especially if it meets other parameters. But it is also a sign of consolidation, and that was the other component. The way you can have a market move, it makes a new high, and there is indecision in the market because it closes where it opens, but the bulls maintain control, and so it'll move sideways for a while. And then you'll see a lot of, we call them spinning tops. If it is a tick or two apart, you can call it a doji, almost a pure doji. But once you get to a relatively medium-sized candle, small tails, those are spinning tops. And so that is showing you consolidation. And if the bulls can reignite their faction, so to speak, then it spikes back up. But it is most certainly something that if you're actively trading, or it's important to see if gold's going to pivot and move lower, that's a good sign. Now, there is, as I said, some things that have to happen.
All right, Gary Wagner, we appreciate the time you've given us, and I look forward to doing this again soon.
Absolutely. Great to be here.
There you go. The candlesticks may be lighting up in the short term for gold and perhaps for silver as well. As always, let us know what you think in the comment section below, and remember to keep it liquid, keep it real. Thanks for watching, and I'll see you on the next episode of Metal Money.